It's Callum Newman here with the Fat Tail Investment Research Podcast, and it's a pleasure to have you with me today. I've got a very special guest for you today, actually. He's my old mate, Murray Dawes. He's the Investment Director of Australian Small Cap Investigator and also the trader for the Pivot Trading Service. And he's been in the game a long time, and he's going to tell us a little bit about a major warning sign that's well, let's say red. We'll say it's gone orange for the moment, but it is indicating a little bit of stress in the market. But before we get there, I wanted to talk a little bit about the recent concern around the Chinese property market. It's really interesting for me. I'm sure you would have read about the company Evergrande, which is one of the biggest property developers over there. A lot of scare stories about it going into default, and iron ore, which is obviously tied very closely to China, has got absolutely hammered. Down about at one point it went from $230 a ton down to 90. It's bounced. So BHP, Rio, and Fortescue all got hammered over September, and of course we had the market sell down in September as well. So I just thought I'd touch base on that. I put aside info about China when I think it's important, and my view is that crisis will be contained. And to touch briefly on it, it's not news to the Chinese government. The property's in trouble, and they've been trying to reduce leverage in the Chinese property market for a long time. So I believe they have the contingency plans in place to contain that. But you don't have to take my word for it, because we can see it via the share prices of the three stocks I just mentioned, which is Rio, BHP, and Fortescue, and the iron ore market. So if the market was concerned or further concerned about the problem in China, we'd expect iron ore to go down even further, and we'd expect them to keep falling. Now, as of now, iron ore today is up 5%, so it's gone back over $120 a ton. Now, the interesting thing about that is that it's still a very, very high price for iron ore. It just shows you how crazy ridiculous iron ore was over $200. So I went back through Rio annual reports for the last 5 years. I mean, most of the time the iron ore price was under $100. So again, it doesn't indicate major stress to me. So there may actually be an opportunity to take a look at those stocks, especially if you're interested in income, because they have big cash flows. And it could be a potential opportunity to get an entry on those. And I'm not recommending it because we don't do that in that podcast, but just look at it. And another way to, if you are worried about a Chinese property collapse, you can use those stocks as a bit of a guide. So if they hold steady or start trending up again, well, that will be the market saying, for the moment, it's not worried about further contagion from China. So I thought I'd give you that thought for today, and something to watch for. I know today's recording this on Monday. Those stocks are up today, where the market itself has been fairly weak. So again, just indicates to me that the market has got comfortable where the China property situation is, and now it's a question of where we go from here. But I would suggest that it gives us a good place to put a stake in the ground and see how things trade from here. So I'll leave you with that thought about iron ore and China. And now we're going to go and talk to Murray, who's going to tell us about what's been happening in the US and why he's a little bit worried that we might see further volatility across all asset markets. So get ready for Murray. Well, I mentioned earlier that today I would have my colleague on, Murray Dawes. And Mars, I hate to introduce you this way, but my wife pointed out that my name's Callum and your name is Murray. So it's the Calamari podcast today. So it's a pleasure to have you on.
Brilliant. Glad to be here.
Sponsored by Birdseye. I'm just thinking about that sponsorship. We got you on because one of the key themes you've been tracking in your service is what's happening with the US bond rate, which is tied in with inflation. Now, the background to this, of course, is we've had this massive surge around the world in power prices. Coal and gas is going bananas. Now, suddenly the big guys are getting worried about what this all means. And everything, as you know, pivots around what happens to interest rates in America. Can you fill us in what you've been watching, what you're seeing, and where you think it's going?
Yeah, absolutely. I think it's really important for people to focus in on the US bonds right now. Most of the time, they're incredibly boring and not much goes on, and you sort of look at them every few months to see what's happening, and usually it's very little. But we're just in a situation now, especially on my technical model, where my ears are really pricked up. We're heading towards the tapering. That's coming next month potentially. So that's going to be less asset purchases, less buying by the Fed of US bonds, which will possibly see a rise in rates just on the back of that. We have huge infrastructure bills coming down the pike, trillions of dollars of spending that will increase supply of US bonds. We have inflation figures already really high, so that real rates are negative. And we have this crisis going on worldwide with LNG, coal, oil prices going vertical, which ends up feeding through into inflation, of course. So you're starting at a very high point with inflation, and you're going to kick in this crisis on top. So for me, looking at the US 10 years at 1.5% is like, wow, that could go a lot higher very quickly if things start to really turn. And I want to show you the technicals, because for me, it's about the perfect setup for me to show you really the crux of my model of what I look for. So if we have a look here, this is the US 10-year bond yield chart, and it's very important for people to understand when the yield is dropping, that means the price is going up. And when the yield is going up, that means the price of those bonds is dropping. So this chart's a bit of a topsy-turvy chart, so I don't want people to be confused. So just looking at this chart over the last 10 years, we had this rise in yields back in 2013, 2014, and that really set up the conditions for the range trading that's gone on for the past decade. So, and people, if they've watched my videos or read my articles, they know that I look for these false breaks of a range where prices end up heading back towards the point of control. It's like mean reversion. Prices try to get away from the mean, from the midpoint, and when they fail to do that, they return to that midpoint. So if we just look at that in relation to that monthly chart, I just want you to focus on the fact that we've got this range that's been set up, and really yields have oscillated around that for the past 10 years. So you can see we've had false breaks of either edge of that range, and yields go back to the midpoint. And this is the most important point of what I want to say, is that midpoint, or the point of control, as I call it, of that 10 years trading. And that's a really pretty POC written there, isn't it? Terrible. Now, 2.2% is that midpoint of that range of the past decade of trading. And when we had the COVID crash, yields got absolutely hammered down to 0.3 of 1%. Now, that actually is, funnily enough, a Fibonacci level outside that range, which I think is very important, the 618, the range, outside the range. That's where I can often see reversals, big reversals. And we did see that at that point, and that's where yields have basically moved higher from that 0.3% rate up to 1.8%. Now, the last few months, yields have backed off. Everything's got rallied again. All the tech stocks have taken off again. Everyone's calmed down, said, oh, it's all fine. But just in the last few weeks, last month, we've seen those yields base. They headed back to about 1%, and they're just shooting higher now. Now, the main point I want to say is that if we head back above that 1.78 region, which is only less than 20 basis points away, it could be there in 3 days, we don't know. But if we see yields heading back above that point, which is the high in yields that we got earlier in the year, basically my model says that it really should have quite a quick trip back to that point of control, which is around 2.2%. So that really is what my model is saying, that we're at a point where it could really accelerate. And with everything that's going on, with tapering, with the infrastructure, with inflation taking off, all of those things are pointing to me as a bit of the chance is increasing that we could actually see a bit of a disorderly sell-off in those 10-year bonds. And if that happens, the equity markets will react, the tech stocks will sell off, gold could come under pressure if real yields really do spike higher. So it's just one of those things that I think, usually the bonds, you ignore them. Right now, I think you shouldn't ignore them.
So essentially, from your perspective, Moses, you're saying this is a risk threshold that's gone up a little bit. Those flashing, maybe orange, red before it was green, if you like. Is that fair to say?
Yeah, it's been at a point where we've got a decade-long fall in yields. I mean, that's the trend down in yields isn't under threat yet. Basically, the 10-year bond yields would have to go above 3% to threaten the multi-decade-long downtrend in those bonds. So, the chances are we'll probably see a spike in yields, growth will really come off, and those yields, the bonds will get bought again. But we're just in the phase now where I think we could see the yield actually surprise to the upside. And I think if that happens, it's just going to be something that if you're managing your portfolio, you just need to be aware that we could be on the edge of quite a sharp sell-off that sort of surprises many in the market.
And we should say that this is a really difficult market to get a grip around. When you were doing your point about the point of control, I remembered that point in 2016. I don't know if you remember it, but the man they call the Bond King, Jeffrey Gundlach, came out and said, "Yeah, I'm putting it on the line. This is the bottom in rates. It's up from here. Da 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 da." And he was right for I think about a year and a half, 2 years, and I don't know what he thought afterwards. But as we know, COVID came along and drove it down even further in the end. So it's
they do. I think it's called the widowmaker trade. Trying to short,
there's a few of those, but it's definitely one of them. But I still remember back in 2012, like even a titan of the investment world, Jim Rogers, going, "No, I'm short government bonds. The Fed's printing too many, and it's going to be inflationary and all this sort of stuff." And here we are in 2021, and as you say, it never really happened. So it's been really tricky. But I guess this is what makes it so interesting that it has gone on so much longer than everybody thought. Well, essentially, as you said before, it's been going on since the 80s, this massive
it's a whole generation of falling yields. That's all we're used to.
So it is going to cause volatility, or I think we can definitely say that. Now, you mentioned gold there could get hit in the US. So the gold futures generally trade in the US. Here in Australia, it's just one thing I was talking about in the Daily Reckoning today, is such a weird dynamic going on. Our gold miners have been smashed in the last year. They've been absolutely hammered down. They tried to rally earlier this year. They couldn't hold on. They seem to be sort of based around now. The Aussie dollar has come under pressure too. So the Aussie dollar margin for gold producers is really good. So they've got these big cash flows. But obviously the market was obviously, I would say, worried about the scenario you're painting now, because it just sold them down anyway. So when you're talking about gold in the US getting smashed, do you think that the Aussie stocks have discounted that a little bit already?
Yeah, I'm actually starting to see a bit of bottom fishing come into those gold stocks. And I've actually been collating a bit of a list of what my favourite gold stocks are, ready to go, because a few of them have come right back to a point where I think they are going to be good buying. But the only thing holding me back is the fact that the bonds look so sketchy, and I'm a bit worried that we'll see another leg down. I think if we do see another leg down in gold through 1680, which has been the low for this year of this whole correction for the past year, I think there could be a bit of panic selling under there. But I think that will push it down into very strong buying support. So I guess my view is that if we do see inflation picking up, which causes the bonds to sell off, or if it's the taper announcement or the infrastructure bills, whatever it is that can cause it, if we do see those rates spike higher than people expect and gold gets hit, I think that will ultimately be a great buying opportunity if we do see that level crack. But if the 1680 level holds and then things turn back up, I think the gold stocks are starting to look like good value.
Well, I certainly agree. I've been watching them too, and it's been really interesting. And you have to wonder what the response from the Fed would be if we get these yields pushing up. The whole narrative is kind of being, well, they're going to start to raise interest rates. They're going to taper, as you say. Well, maybe that doesn't become an option for them, and they have to step in to push the yields back down again, which would shuffle all the pieces around again. So it's a really dynamic and, I guess, volatile market, not just the market itself, but the different responses that come in from all the big players.
Well, it is. I mean, it's so hard to try to have a macro view of what's going to happen and trying to second guess what the Fed's going to do. And I mean, that's probably why I may have views on all of those things, but ultimately I'll try to listen to what the market's telling me through the charts to make sure that I'm not sort of walking into a brick wall.
Yeah, absolutely. And I know myself, I had gold recommendations, and I was just watching, earlier in the year, and I'm like, we're in wrong. Like, this is not the place to be right now. Like, they were just getting sold down. And so, as you know, I just cleaned them out one day and just said, no, we're stepping to the sidelines here, because you've just got to watch what the market does every day and what the price action tells you. Yeah,
because sometimes it can just be a matter of, some big shareholders that own 10% of the stock or whatever might be saying, I want to sell down. And for them to sell down, it can take months. So you can be scratching your head and reading great announcements and thinking that stocks should be going up, and the volume that needs to be sold is such that the stock goes nowhere or goes down. So there's all these factors that can, bring any best laid plans of anyone a cropper. So, you've just got to go with the flow and be willing to be wrong and run away when you have to, and then try to jump on a trend and hope you survive.
Yeah, well, that's the trading life, isn't it? So it's a very different dynamic if you're you're running a self-managed super fund and you've got your long-term positions there and you're trying to farm it for income and all that sort of stuff, as opposed to being a trader where you can use that volatility to your advantage, which is something I try and do. Obviously, I have a list of stocks that I want to get on board. And if we get a market-driven sell down, I can sort of go, well, I'm happy with that entry price. So, for people that don't know your work, do you try and use volatility in a similar way?
Yeah, well, as I was just showing you on that chart of looking at how those ranges develop, how those false breaks develop, I sort of look for those mean reversion points, which I think are like a gravitational point that the market's going back and forth through, even when it's trending. So I'll sort of look for those points where I can get on and get a quick trip to that mean reversion place, that point of control, and I'll take part profit so that I then create a free option to see what happens next. So really, I'm just trying to plant these little seeds in the market where I can, and it's all based on a fundamental view of the stock or whatever it is, saying, I really like it, but I want to make sure that I'm entering at a point where I've got a good, risk reward, good probabilities to be able to create that free option. And then I don't care, because I know that I don't know. You don't know the future. You've just got to manage the way you behave in the market to give yourself the best chance to survive, for one, and then worry about, making money.
Absolutely. And to me, the other thing with that, when you get those volatile down moves, is you can put a stop loss there if you get a bit of a recovery, and then you go, well, if it breaks below that, then that's a warning sign. But, I expect it to go up, which I wrote a little bit about this idea in the DR last week, where I was watching Rio Tinto, and I had the view that it had got so smashed that it was probably oversold a little bit. And on Friday and today, it's jumped up a little bit because iron ore's bounced on the futures exchange. And now we don't know whether that's going to continue, but that low point on the stock gives you a reference point. And I remember my old trader mate Terence, he'd say, well, you can put your stop loss there if you're going short term and that sort of stuff. If it goes below that, well, you just get out and reassess. But as you say, you can then, if the recovery continues and the buying comes in, the bargain hunters and the dividend guys, you can try and surf that sort of bounce back. So there's lots of different ways to trade the market, and you've got technical sort of mix with fundamentals as well, and that can lead to longer term opportunities or shorter term ones, which gives us a nice segue into some of the positions you've done in energy, where you did position very early in the uranium sector, and you got on board with oil and gas and coal, I think, at various stages.
Yeah.
And what do you want to say, perhaps, what took you to those?
Yeah, I think, look, ultimately there was an overlying, fundamental basis where you're looking at markets like uranium, which had been, killed for a decade. and it was starting to pick up that there was a bit of a basing formation starting to come in. And, just reading about it, you could see that the demand supply dynamic there was starting to shift, and that within a year or two, things were going to change. So it was not necessarily knowing what was going to happen. It was just starting to see that this is an area where there could be quite a sharp shift. When you've had a market that's been oversupplied for a decade, and then it starts to pick up and starts to turn, there could be a really great opportunity there. And Paladin, which we got into at about 12 cents before it had the big run to $1, it was all based on what I was talking about, these distributions of price, getting on at a point, capturing the move back to the middle, and then creating a free option to see what happens. I mean, do I know when I entered it at 12 cents that it would go to $1? No way. Didn't have a clue. But it was just about setting yourself up into these positions where you can at least see what happens next by creating that free option. And with the coal and oil and gas, I mean, it's been brewing for a while. I mean, I saw the big spikes in gas that was happening in Asia, and I was scratching my head why Woodside Petroleum was going down every day. And then they announced the BHP deal, and then everyone was saying, oh, we're selling BHP, selling Woodside because all the BHP shareholders will dump their stock as soon as they get it. So you saw Woodside getting absolutely hammered, and gas prices were going vertical. And then you started to hear what was happening in Europe and UK, and it all started to add up that there was this massive divergence developing because you had fund managers, selling the stock because they thought, oh, we can't own this stock, and it's, our investors don't want us to own this stuff. So they're selling them at really cheap prices, while the commodity they're selling is going vertical up 400%. So it didn't take a genius to see that there was something weird going on here, and you've just got to have a stab at it.
I know exactly what you're talking about, because I had a similar situation with an oil and gas stock I've followed for years, and I kept looking at it. I was like, it had some problems and all that sort of stuff, but I sort of put the chart of oil against the chart of the stock, and oil had gone, at a 45-degree thing for ages, and going up towards the ceiling, and then the little oil and gas stock had gone nowhere. And you go, what? You see this situation all the time in the market. You go, is it me? Am I missing something? Is the market discounting something that I'm not reading right? But there are just these situations where I think ideas, especially with oil and gas, because we had the environmental concerns and all that, a lot of divestment from the investment funds and that. But there was just so much value there. So when you look at a trade like that, you go, well, how big can the downside be when everybody's dumped it already, and it's got so much cash coming in that it's a profitable business?
Yeah.
It gives you a really low risk entry point. And you never know what's going to happen, of course. And, they can have production problems and all that sort of stuff. Yeah. There's so many of those opportunities around, and that's part of what you look for, isn't it? All that sort of stuff.
Yeah, exactly. And look, it's never easy, because it can stay going against you for longer than you thought. Like we bought Woodies before the BHP announcement, and it went down like a stone as soon as we entered for a while. But thankfully, it never hit my stop loss. But we still had to sit in it for, a month, watching it tick down every day, with me scratching my head, wondering what on earth was going on. But once the BHP deal happened, I realised, that was probably the reasons why that selling was about before the deal and after it. And it really pushed it to a point which was just silly. And but yeah, you never know. You've got to set your stoppies and hope for the best.
In light of what's happened, do you have a view on who's getting the better deal? Is it the Woodside guys getting the BHP assets, or
I think ultimately it will be the Woodside guys will have done really well. Yeah, especially if you see oil hitting $100, and they've just bought these, tier one assets at bottom dollar, really. But I mean, they're merging, and the deal is 55% Woodies or whatever, 45 BHP. So if Woodies rallies, I think they're all going to be okay. It's probably a fair deal. But ultimately, Woodside could be sitting pretty over the next few years, and I think they'll still surprise to the upside.
Well, that's interesting. I own BHP, so I've got a bit of Woodies coming to me if I hang on.
Nice.
I have to keep watching. Yeah, it's really interesting. I've got to say, it's funny. it's so funny with me with oil because in 2018 I was saying to everybody, and I really did believe. Sorry, towards the end of 2019, I thought oil was at risk of spiking, and I was like, there's been underinvestment in the sector for ages, and earlier, so it was in 2018. So I had been thinking that and moving along those lines, and oil got absolutely smashed. Remember in the last quarter of 2018, the US market just tanked.
Yeah.
And oil got caught up in all that. And now everyone's getting bullish on oil, and I think I'm still mentally scarred from that period. So I'm still wary of oil. But I can say that, and when you talk about expectations and things going, I've been skeptical all year and it's gone up. So again, with the psychology of markets, you get guys like me who have maybe held off, and then suddenly they're like, well, I'm wrong. I've got to get in, or I should get in, kind of thing. And that's how you can sort of get these upside swings that last a lot longer than you might think, and all that sort of stuff. And then something happens and scrabbles all the board again.
Well, I think, yeah, for me, training myself to trust the charts, despite my view, is hard. Like, it really is to just say, right, the charts are saying that you're wrong. The trend has shifted. Doesn't matter how much work you've done on this. You're probably wrong for the moment, so get out. Or, and it is a really hard thing to train yourself to do, to ignore what's going on in your head and to look at what's happening and say, no, I'm going to trust that, rather than trusting what's going on in my head. And it's a really tough thing to do, and I still trip over that one. But hopefully you don't blow yourself up in the meantime.
Well, and I should say, this comes back to how we approach things at Fat Tail Media. Like, it's so seductive to read people who agree with you. If you have a viewpoint, you want to hear from the guys that agree with you, and you go, oh, isn't he, spot on? But you need to read from the guys that don't agree with you, because so often they're right and you're wrong, or at least in the short term, or they have a different viewpoint, or, there's always someone else on the other side of the trade. So I know people who sign up to multiple services often get frustrated, because you might go, I'm excited about oil and gas, and then I'll go, oh, geez, I'm a bit sketchy on it. I'm not sure. But that's just the nature of the market, isn't it? You have to absorb where everybody's positioned, what they're thinking, and then ultimately, especially in your case as a trader, you go with what the market is going with as much as you can.
Yeah, well, I mean, look, you can be a bull, I can be a bear, and we can both make money. It depends on how we trade and how we position ourselves and where our stoppies are and all that sort of thing. So, bulls and bears can make money and pigs get slaughtered.
That is a very old expression. All right, well, I think we can leave it there. So the takeaway for today's talk, as far as the pressure building in the US government bond market, is a danger sign in general for asset markets, because it's going to cause volatility and it's going to be hard to read. So I guess in your case, with a trader's view, you're either limiting how many new positions you're going to take, you're going to tighten your stop losses. What do you do going forward?
Yeah, I've been taking profits for a while now just to lower exposure, but I'm still long. Like, the equities can look fantastic again with a good week, but at the moment the weekly for me is negative. So I'm just wary that it could turn into a bit more. So while the selling pressure's there in the US equities, and the US bonds look like they do, I'm just sort of taking a bit of money and not 100% long now, and just seeing how it plays out, because we know it can all change on a dime depending on what the Fed says or whatever. So just that's sort of my view at the moment, is treading a bit carefully.
All right. And for those that want to follow you, you do a weekly update at the end of the week, right? You do a sort of ASX wrap up.
Yeah.
People follow you for that?
Yeah, on Saturday, the closing bell video they can check out. I do an article there for Traders Corner, where I sort of write about different aspects of trading, and then do a bit of a market wrap and have a look at, if there's any little stocks that I think are looking interesting or whatever.
All right. Well, it's been a pleasure to have you on, Muzz, and I thank you, and we'll do it again soon.
Excellent. Look forward to it.
All righty there. That was Murray Dawes from Pivot Trader, an old mate of mine as well. And as he said, you can catch up with his closing bell summary every week, and we shall pop the link into that as well. So thank you for listening, and we'll see you next week.